Hi everyone. So today I am going to be talking about first-time buyer mortgages. Now, I have done a couple of TikToks and YouTube shorts about it earlier, and I talked about quite a few different options. Now, if you've got any questions, please put them in the chat and I'll answer them as I go. But I'm going to talk through a few of them. Now, at the end of the day, when you're looking at becoming a first-time buyer, there's a couple of things that will hold you back. Now, the three main things when you're getting mortgage ready to become a first-time buyer is, right, so the first thing, which everybody struggles with, is the deposit. So I'm going to talk about some mortgages that you'll need a deposit and some you won't. Now, the next thing I'm going to talk about is affordability. Now, that I will break down how it all works and what it involves, but that is another hindrance. So you've got deposit, you've got affordability, and then the third one is credit. And I've done a lot of videos about all three, funny enough, and I'm going to break them down. So I thought I'd start by talking about about a few first-time buyer stories that I've got. So the reason why, I suppose why I started doing videos like this and getting mortgage ready is because when I got made redundant as an accountant back in 2020 and I retrained and became a mortgage advisor, I just thought it'd be really straightforward. I'd go and I'd talk to people about getting a mortgage and I'd just do their mortgage and that would be the end of it. But my very, very first client that I had, she had saved up for ages to get her deposit. But what she'd been doing is she was a student, funny enough. And as a student, she was in the first year of university and she had lived in halls of residence. I don't know, any of you go to uni, lived in halls of residence. And now the second year she was going to rent, but she realized that how much it cost her for rent, she could actually pay a mortgage for less. So she went on the calculators, figured it all out and whatever. She actually went and applied. So the current account, the bank that she has the current account with, she actually went ahead and applied to them. But what ended up happening, unfortunately, she got declined, but she didn't know why. So that's why she sought me out. And I'd done a Facebook post at the time about why I'd left, how I bought my first property in my 20s, and I've always been interested in property and having buy-to-lets and rental income and that kind of stuff, and how when I got made redundant as accountant I decided to become a mortgage advisor. So I did like a post, a Facebook post on that. And from there, she'd found me, and that's where we went. Now, the thing is, she wanted to know why she got declined, because her credit was fine. She didn't have any adverse credit or anything like that. For her, it was purely affordability. So this is the first lesson we're going to talk about with your affordability. Now, when it actually comes to banks lending you money, they want to see a few things. Now, with this particular person I'm talking about, she had no late payments, she had no defaults, she had no CCJs, county court judgments, she had none of that stuff. As far as you were concerned, her credit was clean. The thing is, her credit was non-existent. She'd never got a credit card. She didn't even have an overdraft. Even her mobile phone she'd paid for in cash. You know, a lot of people get the mobile phone and they have these contracts where you're paying a certain amount a month and some of it goes towards the actual brand new handset that you've got and you change that every year. That actually has a credit footprint. She didn't even have that. The next thing that she did is she did work while she was studying, but all her work was working at cafes and bars and things like that, working at pubs and things like that. And as you can imagine, it's all cash in hand, which she thought was great because obviously, cash in hand, you get all the money, so to speak. I won't judge, but you should declare it and pay tax, but everybody's different. Now, With this, she thought I can earn a lot of money really, really quickly, and that's how she saved her deposit. The thing is, she had it all in cash. And yes, sometimes she'd pay some lump sums of money into the account, but banks want to see, there's a couple of things banks want to see, and I'll tell you this. Now, the first thing is they want to see where the money has come from. So if she was getting, all the pubs and everything, if she was getting them to pay a bank transfer into a bank account, that would have been a lot better than just getting cash in hand. And sometimes she'd spend it, and sometimes she'd put it in her bank account, in her savings account, and that's how she'd do it. But at the end of the day, there was no audit trail, so from the actual where the money originated from and where it went. When you're just putting lumps of cash in, it does raise questions. As I said, the other thing was she had no credit footprint at all, never had a credit card, never had a loan, didn't even have an overdraft. So unfortunately, her credit score was very, very low. Now, for those reasons, she'd been declined a mortgage. So this is when I put on my Get Mortgage Ready hat, and we started working together in order to improve everything. So the first thing I said to her was, all the companies that she's working for, get official agreements, get them to start paying you into your bank account. Obviously, you have to declare it, pay tax on it, so it won't be as much, but it will be accepted. The second thing I said to her is get a card. She really, really didn't want a credit card, and I've had quite a few clients like this that really didn't want to get a credit card. So I said to her, do you have Netflix or any subscription that you have? And she said yes. So I said, this is what I want you to do. I want you to set up your subscription to go against that credit card. So every single month you are charging that credit card, even if it's $7.99 or whatever it is. Then you get a direct debit that pays off your credit card in full every single month. Then you can cut up your card. So you won't spend it, it isn't there, you can forget it exists. But every single month, Netflix, for whichever subscription works for you, it can work for a gym, membership, or whatever, would charge her credit card every single month. The direct debit would come out of her current account every single month and pay it off in full. So every single month she was getting a charge, paying it off, getting a charge, paying it off, which was building up her credit score. As I said, in the background, she was getting now paid into her current account. So over the next few months, she was able to actually build it up. Now, it was really, really good that she came to me at the beginning of the summer. So over the summer, we were doing this work. It takes about 6 weeks to build up your improve your credit. So when she'd finished her exams, I think it was May, June time, this is when she said, I was going to look for a property. I want to be sorted by sort of September, October time. So we were able to do at the time that when I have clients that are just already mortgage ready, for want of a better word, they've already got their bank statements, they've got their deposit, their 5-year fixed or even a 10-year fixed, and you know you're going to knuckle down, pay off as much as you can, with that equity up, then it won't be 100% mortgage for long. So there are sort of ways and means, but you do need to be 100% sure of the type of property you're buying when you're going with 100% mortgage. It isn't all straightforward, so you just need to be careful on that side of things and really, really sort of look into things. I would recommend speaking to estate agents, asking them what the likelihood is of the property increasing and things like that. Be sure of your income so you know that you're not going to miss payments, because hopefully the mortgage you will be fixed, so it will be the same amount every single month. So as long as you know you're earning enough to cover it every single month, then you don't need to worry as much if it's 100% mortgage. It's only, if you're self-employed and you might miss payments, things like that, then it can be more of a concern. But always make sure that you feel comfortable paying your mortgage, because it will get repossessed if you miss your mortgage payment. So mortgages are important. The next thing I wanted to talk about is if you've got a deposit but it's a low deposit. So this is why shared ownership can be so popular, because, for example, if you only buying 40% of the property, then you only need a 40% you only need, you know, 5% of that 40% rather than 5% of 100%. And then the 60% would be covered by rent. But when I help clients with the shared ownership, I always talk to them about a staircasing strategy. And what I mean by that is buying more of the property so you can actually own it completely. Now, there are a couple of options. If you went, for example, with a 2-year fixed, in 2 years' time, you could put more money towards it and buy more. Or you could go with, say, a 5-year fixed, and then after 6 months or a year or whatever, minimum of 6 months, you can buy a little bit more of the property. Now, it's definitely worth buying it sooner rather than later, because the one thing they don't tell you is every single time you buy a section of the property, they revalue it. And if the property price is going up, which tends to normally happen with property, they're ascending assets rather than depreciating. Appreciating assets, not ascending, appreciating assets rather than depreciating assets, then what tends to happen is every time you go to buy, you staircase and buy a little bit more. It costs you a little bit more. Also, you need to be aware of stamp duty as well, because, you know, when you get the original 40%, you may, or 25% or whatever you get, you may be under the stamp duty threshold. But what one of my clients did, because she knew over the next 5 years she was going to staircase up to 100%, she actually negotiated paying for stamp duty for 100% of the property rather than just the original amount she was paying for. So it was based on the value of the property at that point in time. So over the 5 years she staircased, she'd already covered off the stamp duty. So that's one thing you can do. Another thing that someone did, not a client of mine, but a friend of a friend, for want of a better word, what they did was they actually owned, so they bought 40% of the property, and then when they wanted to sell it, rather than just sell the 40%, they negotiated buying the 60% and selling it at 100%. Hope that makes sense. So they owned 40. They found out from the estate agent how much 100 was worth. They negotiated that with the seller and said, we'll sell you 100. And then the day they got the money for the 100, they actually gave the 60. So they asked the shared ownership association how much it would cost to buy that 60, and on the same day they sold the property. They used some of that money to pay off the shared ownership to bring it up to the 100%. So I hope that makes sense. Again, this the workshop that I'll be doing on Wednesday will have facts, figures. I've got slide deck. I'm really excited about going through it because I'll be going through every single one. The next one option is, so we've talked about deposits. If you've got no deposit, if you want a low deposit, there are other schemes like the 5% and loads of other options and have the affordability. Now, a great mortgage is different lenders calling it different things. Some are calling it income booster, and some are calling it joint borrower sole proprietor. Now, basically what that means is if you want to buy a property, so it could be you and your boyfriend or girlfriend, you and your other half basically want to buy somewhere, and either their parents or your parents want to help. So they can actually help with affordability. So in the other scenario, they put a charge on their property. Maybe they're still working. Maybe they've got a mortgage, you know, they don't want to put a charge on their property, which is fair enough. Not everybody does, but they want to help in a different way. This is what they could do. They could actually come on the mortgage. So normally it's a 5-year fixed that this is done, because it gives the person who's buying the opportunity to sort of improve their income. So I once did it for a police constable, because her and her mother, because the way it worked is some people really do know their career path. It's all set out, and she knew in 5 years' time what she was going to be earning, and it was going to be enough to cover the mortgage herself. It's just at this moment in time it wasn't enough. So her mum came on the mortgage with her. Her mum earned really good money, and she also owned a property but had a smaller mortgage on that, so she had enough affordability. So what happened was the mother came on the mortgage but didn't come on the deed. So this is what I mean by sole proprietor and sole owner, and joint borrower. Two of them borrowed, but as I said, it can be just one individual and have one of their parents on it. I've done it for one individual with their brother. I've done it for a woman who was getting divorced and was buying out her ex. She was able to get her daughter, her adult daughter, to go on the mortgage to help with affordability. So there's loads of different ways, but the brilliant thing about it is, by putting someone on for affordability but not on the actual deed, means they don't own it, so they don't have to pay additional stamp duty. Because the thing is, when you own a property and you sell it, then obviously you've got the rollover relief. But if you own a property and you buy a second property, then you have to pay additional property stamp duty. But if you don't own it, you're not on the deeds. And when I mean deeds, I mean on the land registry, title deeds as an owner. What happens is, it's the person that is buying, the sole proprietor, that can use their stamp duty exemption. Because the thing is, if two of you buy and one of you is a first time buyer and the second one isn't, you don't get stamp duty relief. So that first time buyer actually loses their stamp duty. The other thing it might be quite useful for is, if there are two first time buyers and one wants to help the other one but doesn't want to lose their first time buyer exemption, so they can go on the mortgage and not on the deeds. The first person who's a first time buyer can use their stamp duty exemption, and then when the time comes, they can remortgage themselves off the mortgage, go and buy their own property. Or if they've got enough affordability, they could go on another mortgage to buy a property and still stay on that mortgage. It all depends on affordability. So those are the joint borrowers, sole proprietor, and with some lenders it's called the income boost. So I've done a lot of those, and I really do love those. I think they're great. But then, you know, if you don't have a deposit issue, if you don't have an affordability issue, and you just want a bog standard first time buyer, that is an option as well. I don't talk about this enough, because I suppose I like the challenge of finding properties for people. But yeah, you can put on your normal 5, 10, 15, whatever you've got deposit. And a lot of people have been asking me about MIPs or DIPs, DIPs, so decision in principle or mortgage in principle. And what I'd like to say about those is, there are a lot of estate agents that say you can IP. That is what you can borrow. It isn't the purchase price, unless obviously it's 100% mortgage. So what you do is, they might ask for a bank statement to prove what the deposit is, and then they might ask for the AIP as well, and then they add them together and they know how much you can spend. Always go with the budget price, not the maximum you can spend. A lot of people are like, oh, can you do me a DIP, decision in principle, for the maximum? And it's just like, well, no, because then you've got no affordability. Sorry, you've got no negotiating power. As soon as, no offense, estate agents, but as soon as you say that someone can borrow, say 250 or 500,000 or whatever, if they come in with an offer 50k lower or 25k lower, you will tell the seller, I know you will, be honest, you will tell the seller, you know what, this is the offer they've put in, but I know they can afford more. Because at the end of the day, you want your commission. This is what estate agents